Mark, thank you so much for joining us here at the PLSA's investment conference. You were talking today about impact investing, social responsibility when it comes to investing. How realistic is it that your business can drive the economic machine yet still be socially responsible?
So we think it's really important to be a responsible investor because we're investing for our members for 10, 20, 30, 40 years. And what we consider ESG risks, environmental, social and governance risks, will play out over the long term. So it's not about doing good or doing the right thing, it's about actually managing long-term risks for our members. And there will be some positive benefits for the world from that as well, but our primary aim is to manage risk.
Some would say it's your responsibility to get the greatest return for your investors. Is that possible if you're doing that as well?
I think to get the greatest return, you actually have to do that because so if you think about the environment, so we have a fund that overweights renewables and underweights heavy carbon emitters. So that's really important because those heavy carbon emitters are not going to do as well in the long term if we transition to a low carbon economy.
So it's actually about managing risk, not just impact investing.
Absolutely, yeah. So impact investing, is often associated with projects such as social housing, etc. Those aren't our focus. I mean, we may at some point, have the opportunities to invest in those sort of projects, but they have to generate a return for our members. So primarily we're focusing on generating returns and managing risk.
Are you seeing more demand from this from the customer now in perhaps a new generation of savers?
We have 6 million members, and most of them have been they've all been auto-enrolled, and most of them don't engage at all. So we're not really seeing that interest at the moment, but we do believe particularly younger members are likely to be more interested about how we invest our money, make sure we're investing it in a responsible way. So that's something. We produce an annual report on our responsible investment activity, and we hope that our members will take an interest in that.
You've talked about engaging with companies as well.
Yeah, we primarily through our fund managers, but also directly engage with companies on the things that we consider key issues, particularly on ESG risk. So, for example, the companies that we underweight in our carbon aware fund, we will speak to and tell them why we're underweight and how they need to have a better plan to transition to a low carbon economy. We've divested our holdings in cluster munitions and anti-personnel landmines, and all the companies that we divested we wrote to and said, this is a reason. And in fact, Singapore Technologies wrote back to us and said, actually, we've stopped manufacturing parts for cluster munitions, and as a result, they've gone back into our fund.
And that may not be a result just from you, because it's got to be a pressure from more than just one
yes,
fund, hasn't it?
So we take steps to collaborate with other investors. And we really need asset owners, the big pension funds around the world, to work together to engage with companies, and because then they'll take notice of what we're saying.
Now, in terms of that engagement, it's important in passive funds too.
Yes, well, even more so because we don't have the option of selling for our equity holdings. So all our equity holdings are either market cap weighted or smart beta, but they're basically long-term buy and hold. So we actively engage with companies, we actively vote our shares, and if anything, we have to take our ownership responsibilities even more seriously than active investors.
Now, there is a thought as well that some of the stocks we're buying now may become what are called sin stocks. Tell me about that and what your thoughts are on that.
Well, so we talked a lot today about tobacco, and in 1900, tobacco was considered, smoking was considered a healthy activity, cleared your lungs or something. So we need to monitor all our portfolios and think about the future there. So we have an ethical fund, for example, which excludes tobacco, arms, gambling, etc. And that has an ethical committee that revises its policy every year and determines what the new sin stocks are, I guess.
Somebody even brought in the tech giants and said, could they be viewed as sin stocks in the future because of tax evasion or responsibilities?
Yes, I don't want to prejudge anything, but we do engage with companies about, for example, tax payments across all our funds. So we think that companies are active parts of the economy and society and should pay a fair rate of tax across the world.
We talked about the end user and the influence they can have. You talked about yours being auto-enrolled, so not having as much involvement. But do you think increasingly, particularly a younger client, will push for more ESG and impact investing?
We certainly hope they'll become more engaged and may well do, but ultimately we have to manage the money for all our members, whether they're engaged or not, and we have to invest responsibly because that manages the long-term risks. And
do you think more younger people will save full stop if they think that their money is being invested in more socially responsible funds?
So that's a good question. We haven't seen any sense of opt-out increasing in companies, in pension funds that don't invest responsibly, but again, we have different fund options, including an EFCO option. So even if our members didn't like the way we invest, and we think we invest in a very responsible way and manage ESG risk, there's that EFCO option if they choose to take that.
There has been a slightly cynical view that ESG has been talked about a lot by companies, but it's lip service. Do you think that's evolving and changing?
Well, we're certainly putting pressure on the companies we invest in to go beyond that. So there was for example, a shareholder resolution at ExxonMobil last year, and that was upheld by the shareholders to improve their climate impact disclosure. So that, companies are beginning to have to take notice because more and more shareholders are active in this space.
You talked specifically about carbon earlier, and an abrupt move to low carbon is going to significantly change the assets that some of the oil and gas companies have.
Yeah, absolutely, which is why we are underweighting the heavy carbon emitters, but at the same time engaging with those companies to try and improve the shape of their portfolios. So, for example, natural gas is a lot cleaner than coal. Renewables are cleaner still. So we are overweight, for example, utility companies that have more exposure to renewables.
Have you been having some interesting conversations? There's 1,000 members of your industry here. Is this a great opportunity to come together and collaborate and share those ideas?
Absolutely is. So there are other pension funds that are investing in a climate-aware way, and our aim is to talk to them and see if there's joint engagement we can do.
Hopefully this will be a useful coming together and meeting point for you in Edinburgh.
Absolutely, yes.
Well, thank you so much for joining us.
No
Good
problem.
to talk to you.
Okay, thanks.